Greetings, investors. Welcome to Investor's Edge. My name is Gene Melamud. I'm with Raymond James Private Wealth Management Group, and I'm here with my esteemed colleague, Hunter Burnett. We are here to talk about capital gains. I'm actually very excited to do this video for you because capital gains from actively managed mutual funds are sometimes a surprise to clients. You can receive a capital gain from a mutual fund that's actively managed even during the down year. When you buy into an actively managed mutual fund, you buy into the underlying securities that the mutual fund purchased when it was incepted. You're not establishing a new cost basis when you get into the fund. The mutual fund that purchased a stock 10 years ago and its cost basis in that stock is your cost basis when you buy into that mutual fund. So around September, October, when most actively managed mutual funds rebalance their portfolios because they're required to do that by the prospectus, and they take some gains, part of that gain will be passed on to you as a shareholder. So even though the stock appreciated significantly since the time the mutual fund had purchased it, and it may be down during the year like last year, if a mutual fund had to rebalance the portfolio and some of that position had to be sold, your proportionate share of that capital gain will be passed on to you. Starting 2021, the capital gain distributions from actively managed mutual funds have been relatively high, and some customers have been surprised by the income tax. So we have a potential tax-saving idea for you. Right around October, November, most actively managed mutual funds come out with capital gain distribution estimates. You ought to be able to get an idea for what kind of a capital gain you're going to receive in December based on these estimates. If you want to mitigate that capital gain consequence, you can consider looking at the cost basis of mutual funds that you already own in taxable accounts where the cost basis is actually higher than the current market value.
So Gene, what if I buy two mutual funds, both at $20, one appreciates to 25 after the distributions for the year and one goes down to 15, and you're telling me I need to mitigate some of those capital gains? How would I do that with that?
So I think a better numeric example would be like this. Let's say we purchased $10,000 into a mutual fund.
Okay.
And let's say today that mutual fund is worth 11 grand.
Okay.
I put in 10, it's worth 11, I'm up $1,000. Good, right?
It's great.
But the last couple of years, I could have been distributing capital gain distributions in December, receiving those capital gain distributions that were $1,000 to $2,000 every December. When I add those up, if I'm reinvesting them, my cost basis could be $14,000, $15,000, just as an example. So if we have a cost basis that's 14 or 15 grand, and the market value is 11 grand, even though I'm $1,000 ahead of what I originally put in, I'm $3,000 under the adjusted cost basis. Every dollar that you receive from a distribution in a mutual fund, whether it's dividends or capital gains, that you put back into the mutual fund is an addition to cost basis. Most of your brokerage statements show what you originally put in, what the cost basis is, and what the market value is. So that when you're looking for an opportunity to harvest losses, is what we call in this industry, meaning move from one fund to another. And if you do it in the same fund family, that generally shouldn't generate transactional charges. You shouldn't be exposed to any kind of additional fees, right? And if you're in a fee-based account, that shouldn't have a transactional charge either. But by moving from one fund to another, that is considered a sale and a purchase. Your adjusted cost basis will be applied to a sale. Most people who have actively managed funds, especially bond funds, have opportunities to harvest some losses, mitigate the capital gains taxes that are coming from the distributions that are most likely going to be coming your way at the end of the month.
Be mindful when switching from fund to fund or when selling a fund of the Walsh-Shield rule, which is purchasing that same fund or nearly identical comparable fund back within the same 30 days. It will not register under the tax loss harvest or any sort of tax benefit for you according to the IRS. Just keep that in mind.
So be careful, talk to your financial advisor, talk to us. Happy investing.